Welcome back to another episode of the Isn't That Rich podcast. I am one of your hosts, Ashley McVicker, and I am so excited to bring my other host in from the great state of Florida, Jill Franks.
Hi, everyone.
Hey,
I'm excited
Jill.
to be here.
I'm so jealous of you right now. I can see the palm trees in the back.
And it's not fake, so it's pretty exciting. And I heard you guys are getting lots of snow today, so
yes,
I feel extra special.
We got a lot of snow today in Southern Illinois, so.
Oh. Well, it's nice that we can actually see each other because it's been a couple of weeks since we've been face to face, Ashley.
I know, I miss you, but I am excited to get on this podcast today. We are really excited because we're going to talk about debunking basic banking lingo. And it's like, there's so many acronyms and words that go into banking that we just say all the time. And no one really knows what they mean unless you work in the bank. I remember when I first got started and I was like, what's APY? What's a DDA? What's a CD? What are all these different acronyms? But they're really not that hard, and they're products that we use every day, and so do all of our consumers.
I feel as though I still have trouble sometimes figuring out the lingo that our tellers use or our mortgage officers use. So I'm glad that we're sitting down and going over those today, because you don't think about it. And that's the same thing we talk about every episode is, walking into a bank is so intimidating. And part of it is the language that we use. And so if we can not dumb it down, but humanize it, right? Make it to everyday language, it'll just kind of make things easier for everybody involved. So we're here to do that today.
Right. And I think if you're somebody that's sitting down for the first time, getting a mortgage, getting a checking account, getting a savings account, whatever product in the bank you're going to get to you. And we want to encourage you to ask questions as you are sitting down with your loan officer or your new accounts representative, whoever you are sitting down with. They are willing to teach you everything you need to know about banking. But we're going to help you look like an expert before you even step into the bank, right?
That's right. Let's get to it. What do you think? What's our first lingo we're debunking?
First
Ashley.
lingo word is APY, and you will see this all over different pamphlets, maybe on a sign somewhere. APY stands for annual percentage yield, and this means it is the percentage reflecting the total amount of interest paid on an account based on the interest rate and frequency of compounding.
So that's a lot.
That's a lot. Like, what the heck is APY? Why?
Let's break this down. So annual percentage yield. So when you go into a bank and they talk about different options for a bank account, they talk about the interest rate of return that you will get on the money in that account.
Mm-hmm.
And some bank accounts have, they are interest. You can get money or earn money on your account with the money in there. And then there's some non-interest bearing accounts out there as well. But we'll talk about that in a little bit. But an annual percentage yield is like that amount that you will receive on how much money you put into the bank. Right.
So Jill, are they going to give me a percentage? They're going to tell me, like, if I'm in a checking account, you're going to give me 2% APY?
Yeah, so it should be well or clearly disclosed on the account that you're choosing what your rate of return will be. I know I like to think of our interest-bearing accounts. We call them our Kasasa accounts, right? Mm-hmm. And our Kasasa cash account earns up to 3% on the first $10,000 you have in your account. So you're getting a larger rate of return if you put up to $10,000 in that account every month. So I think that it's like $7 a month that you can earn up to in that account, which is kind of exciting.
Yes.
So if you think
and we have another Kasasa account that you can get 2.05% back on it, which means that whatever you have deposited right there, if you do all of the things you have to do to get your rewards, you can get that money.
Yeah, it's kind of exciting. And usually accounts that are interest bearing or have an annual percentage yield on them, they do require you to jump through a couple of hoops, like do a certain amount of transactions or maybe log into your online banking. There are certain requirements for those, but it'll be clearly disclosed when you open that account. And so look for, I think, you might as well be earning some kind of interest on having your money in the bank. So look for an account with an annual percentage yield, APY.
Yes. All right.
I think
APY.
let's move on to the next one, because this is one I still hear people saying all the time, and it takes me a second to remember what it is. It's POD.
POD. I've had to sign a POD in my life.
So POD stands for payable upon death, and it's essentially a beneficiary that you're selecting for your account.
Yes, and you want to have a POD. We talked with Taylor Shanks last episode about this. You want to have a POD on all of your accounts, all your investment accounts, all your checking accounts, everything, because if you don't, that money's going to go not to somebody you want it to go to, right?
Right. So like if something happens to you, the balance of the funds that you have in the account, when the last owner on that account passes away, that money goes directly to that person that you point as your POD.
Yes.
So POD is payable on death. That helps you to remember that that money is going to that person should something happen to you.
Yes. If you want to learn more about PODs and beneficiaries, we encourage you to check out our last episode. It was about changing your name when you get married, and we talked a lot about what your bank account looks like. So if you want to learn more about PODs, you can check that out. All right. This one, Jill, I still have a little bit of issue with. I don't know why, and we laugh about it all the time. But what the heck is a CD?
A CD. I love this because a couple of years ago, when I think of a CD, this is the first thing I think of. A couple of years ago, we did this interview with kids in the community. It was called Tiny Talks, and we asked them about banking terminology to see their answers, right? And one of the questions was CD, and every single child that we interviewed was like, yeah, the circular disc, it's that silver thing that you put in the bank. And honestly, that's the image that comes to mind when I hear CD, but that's absolutely not what it is. A CD is a certificate of deposit. And essentially, a CD is a savings account that has stronger requirements to it. So you can't withdraw funds before the account's maturity date without paying a penalty with a CD. So a CD is just a safe place to plant your money for a longer period of time, and you earn a larger interest.
So I know that a lot of people right now are calling the bank asking about rates, and especially CD rates, because those fluctuate, right?
They do. Yes, they absolutely do. The rates fluctuate depending on if the bank is running a special for a CD. That typically means that the bank is looking to earn more deposit accounts so they can loan more money out. So maybe they're running a little low on funding or funds at the bank. So they'll run a CD special, giving a higher rate of return for a specific period. And then, yeah.
Great. So if you are looking to lock up your money for a few months to a year, or maybe even longer, and get some higher interest, you can look into a CD.
That's right. What is the next lingo we're debunking, Ashley?
So the next lingo that we are debunking is a DDA. And this is funny because Jill and I were talking about this morning. I always thought it was a direct deposit account, but it's actually a demand deposit account, right?
Yes, it is. It's demand deposit of a deposit account. And what I like to think about it is like with a DDA, you're going to get your money whenever you want it on your demand, right? So you'll be able to make withdrawals or deposit funds whenever you need to. Typically with a savings account, like we mentioned before, or a CD, there are requirements. With the CD, you can't touch that money without penalty for a year or whatever term you set. With a savings account, typically it's 6 transactions a month that you can do. And after that, there will be a fee, or your account will just lock up and you won't be able to withdraw that fund, right? So with the demand deposit account, you can access that money whenever you want to. It's typically a checking account.
Yeah. So that's the money that you're using when you go swipe your debit card, right?
Yep. Checking account, swipe that money. Card, deposit whenever.
Money on demand, DDA, that is an easy one. And when you go into the bank and get a bank account, that is what it'll say across the top of the papers you sign for that. So don't be like, and I got a checking account, not a DDA. No, you got a DDA.
Yes, a DDA checking account. Account number and routing number is our next keyword that we are debunking.
Yes.
What do we use those for, Ashley?
So they're two different things. And an account number is going to be way more locked up, private. That is your own personal bank account number for a singular bank account. That is not to be given out to anybody. That is for you and you only to know. It is directly connected to a specific bank account with a specific dollar amount. A routing number, on the other hand, is a number for the entire bank. So a routing number is a public number. Everybody uses it for that specific bank. So Farmers State Bank, you can get on our website. You can find our routing number there. Those are also going to be at the bottom of your check along with your account number. So when you get an account, you are going to have the bank routing number, and then you're going to have your account number. And never, ever, ever give your account number to anybody, because that is how someone can get into your account and look at your money.
Yeah.
And that is the number that you put into things like if you're getting your direct deposit set up at your job, you have to give them your routing and account number. So it is a very, very important number that is to be kept very under lock and key.
Yeah, maybe think of it as your social security number for your finances, right? You don't give that to anybody.
Right. And a banker will never call you and ask for your account number. We know your account number.
That's such a good point. We will never ask for that over the phone.
Yes.
We know it already.
Yeah. That's one thing. And we've talked about this on our fraud episode, that people will spoof the bank phone number and call and ask for your account number. Never, ever, ever give your account number to anybody. We know it. We're the ones that have that information, and it is our job to keep that secure. So you keep it secure too. The next basic banking lingo that I want to talk about is an ACH draft.
I didn't realize what ACH was for a really long time.
No, me neither. I remember my mom, like when I first got my first job ever, and she's like, just do an ACH draft to your bank account. I'm like, what the heck is that? I thought they were just going to give me cash.
I know, right? Or a check, or the weekly take-home check.
Yeah, I didn't know where my bank account was. I didn't know where my debit card was. I didn't know anything. So an ACH draft was definitely out of my scope of understanding for banking.
Yes. So let's explain it. So an ACH draft, an automated clearinghouse, is a computer-based electronic network for processing transactions, usually domestic, low-value payments between participating financial institutions. Okay, that's the definition.
Yeah.
But ACH is essentially a wire, right? Wire transfers, or so say you go to pay a bill. That's an ACH transfer. So if you sign up for bill pay at your electric company or something, and you pay your bill through that, and ACH is essentially paying that wire transfer that moves the money from one account to an external one.
So it's basically just moving money around, putting money into different accounts.
That's right. Or like you were talking about your paycheck, Ashley, there is from one financial institution to the next, that money is being transferred. So your employer's bank account makes a transaction to your personal bank account. Yeah.
We love an ACH draft. I know I love it on payday. So that's great.
And it's actually, so we talked about like our Kasasa bank accounts, and one of the requirements is to have an ACH transaction one a month. So making one of those wire transfers a month is required, and you'll get your rewards.
Yeah. So if you have a job and you get a direct deposit ACH, bing, you get a reward.
Check that one.
Check that one off. You got to do all four though. All righty. Okay. Prime. I love this one. Jill taught me about Prime like a year ago. I remember when the real estate market was super hot, and she's like, because Jill used to be a big real estate guru. She still is. But anyway, she taught me about Prime. I'll let you talk about it, Jill, but I love Prime, and I love to teach people about Prime now because it's really cool.
Well, it is. I don't
know if I would say it's cool actually, but it's an interesting topic.
I'm just going to read the definition because I feel like it's a little bit easier to understand. We can break it down after that.
Yeah.
So the U.S. prime rate is a commonly used short-term interest rate in the banking system in the U.S. So all types of American lending institutions, traditional banks, credit unions, etc., use the prime rate as an index or foundation rate for pricing various short-term and medium-term loan products. So this is the rate out there. So the Fed sets prime. So you'll hear this all the time. The Fed meets monthly to determine the prime rate, so the US prime rate. And then if they decide to raise rates, that determines how much your bank charges for a loan. So we've noticed this year, especially, there's been lots of raising prime, lots of raising rates. So interest rates have skyrocketed this year. We know that. So prime has been raised several times this year. So whatever the government tells us prime is, then we have to base our pricing for our loan products on that rate.
Great. So back in 2020, when the real estate market was super hot and everybody was buying houses like crazy, that's because prime was like really low, right? What was it, like 2, maybe 3?
Well, at one time, I remember our mortgage rates were down to like 2.25%, which
That's
is
cheap
unheard
money.
of, right? Yeah, and now it's somewhere around 7%.
Yeah,
so
which is still not a bad rate, but
no, like we talk about in our parents' lifetimes back in the 80s, rates were at 14 to 16%, which is extremely high. And I've never seen that in my lifetime. So when you hear about that happening relative to what we're seeing today, we're still not at those crazy extremes, but it is significantly higher than it was 2 years ago. So,
yeah. So I feel like people that didn't buy back in 2020, they're like doing the math now and they're like, oh my gosh. Basically, you could get more bang for your buck is what a low prime rate means. So,
right.
But
exactly.
Yeah, prime is basically how we price our loans.
The next term, and we kind of touched on it, Ashley, is interest bearing and non-interest bearing. Can you talk about that a little bit more?
Yeah, I think these are pretty straightforward. Interest bearing means an account that bears interest. So you can make money for putting your money into the bank. Non-interest bearing means you don't bear any interest. You will not make money because your money is in the bank. There's nothing wrong with either. It just means that if you have an interest-bearing account, you can make a little bit of cash for letting us use your money to lend money. The difference is if you have an interest-bearing account like the Kasasa account we talked about, and there's plenty of other checking accounts that we have, or DDA accounts that we have now that we know that lingo. You might have to swipe your debit card a certain amount of times. You have to be receiving e-statements. Each account has different stipulations. They're not hard. Typically, there's something you're already doing and you're not even thinking about it. And then with a non-interest bearing account, the ones that you're not going to make any money on, they typically don't have any stipulations. You don't have to keep a certain amount in there, or you don't have to have a debit card at all. You don't have to even receive a statement. So there's just different stipulations. One, you can make a little bit of money, and one you can't. So interest bearing and non-interest bearing. So when you go into the bank and you're wanting to get a deposit account, say, I want interest bearing, or I'm not interested in an interest bearing account. But I don't know why you wouldn't want interest. I mean, make some money off your money. That's my 2 cents there, but
I agree. I think about some of the customers that come into the bank and just why would someone want a non-interest bearing account? And I think of like our senior checking accounts. Maybe you're not planning on keeping your money in the bank for a really long time. It doesn't really matter to you, or some of the requirements we have, like we talked about, that ACH payment or transfer. Maybe they're not up to doing that. So in exchange, they don't really care that they're receiving interest on the account. They just want their money when they need it and not to have to deal with all the other hoops you have to jump through. And that's the only reason I could ever see somebody not really wanting interest. But yeah, both have their positives and both have their negatives. Okay. The next one is principal. Ashley, you want to talk about that one too?
Okay. I love this topic too, because I love to talk about the loan side of banking. So principal is the initial size of the loan or bond and the amount that must be repaid. So we just were recently talking about interest, which is the money the bank makes for letting you use our money. But principal is the actual amount that something costs that you are borrowing. So if a house costs $150, the principal is $150. And then the interest is anything over that you pay back to the bank. And if you're wanting to pay off your loan early or, add an extra payment, typically you always want to add that extra amount onto the principal. You want to pay your principal down, because why would you pay interest? You want to pay the principal, because then that's the money you're paying back. Does that make sense? Maybe you can.
No, that totally does.
Speak a little more onto it, Jill.
You said it right. Yeah, no, you said it right. Like, principal is the initial amount that you're taking out a loan for. And in return for a bank lending you money, we're going to charge you interest. So the faster that you pay down the principal on your loan, the less interest that you have to pay. So,
yeah. But it's such a weird term. I don't know why and who picked principal for that to be, that word, but that's what it is. So when you're going to buy a house one day, just know that you're going to be you're not paying two different things, but there's two different aspects to your loan payment. One will be your principal amount and then interest.
And I like to think of it this way. And my husband always gives people advice. The shorter term loans, he loves to recommend anything less than 20 years because banks front load the interest on a loan. So we're going to want to get when you're making a payment on a loan, you're paying that interest amount first instead of the principal. So if you decide that you want to pay your loan off early, like we talked about in the previous episodes, you want to make sure that if you're making a larger payment than your actual payment required, that you tell the bank to apply that extra amount to the principal. So you're paying the principal instead of the interest down faster.
It's funny now that I know all this, because when we check our night drop or look at checks, when people are paying their bills at the beginning of the month, they always write real big, apply to principal, because you never want to apply it to interest. That wouldn't make any sense. Apply it to the principal always. And I don't like that you have to even state that, but you do.
Say that. You do. I think principal is a funny term because do you remember learning to spell principal in elementary schools?
Yeah, because the pal.
Principal.
Principal is your pal.
This is
principal.
The principal. Yeah, pay this one down. It's the pull.
Principal, it's pulling money out of your bank account to pay for somewhere to live.
Yeah.
Think about it that way. All righty. So that's principal. We've got a couple more basic banking lingo terms to get through. This next one, and I think it's our last one actually, is an NSF fee. Jill, what's an NSF fee? Yikes.
No one likes these.
No.
Non-sufficient funds.
Wow.
An NSF fee is essentially an overdraft fee. So you didn't recognize how much money you had in your bank account and you spent more than you have. So essentially, you're getting charged for using money that's not yours.
You took out a loan. Essentially, yeah. Jill, you said this yesterday, like you took out a loan because you went in the negatives in your bank account. I did this at Subway one time. I was mortified.
I know. And I know there's a lot of people out there that put up a big fuss about NSF fees, but really
you're borrowing money from us because we're covering your bill. So when I went to Subway and I swiped my card and I had negative $32 in there, this was in high school. I'm way better at managing my money now. But the bank had to front me $32.
Right.
And so,
and what if you never pay that money back? Like what if you just decide to go in the red and you never get out of it? That's the bank's way of recouping those fees. So is it fair? I don't know, but it is, you are using money that's not yours. You are taking out a loan essentially. So the bank will charge you a little fee for that.
So keep those bank account numbers in the positive. Don't be like me as a 16-year-old at Subway.
We like it green.
We like it green. Yes. Check your mobile banking before you go into a store or before you do online shopping. Make sure you have that money in your account or you will get charged by the bank. unfortunately.
I love it. All
Wow.
these terms are awesome.
Yeah.
I feel like.
And there's so many more, and maybe we'll do another episode on those. But for now, that's a lot to do with banking. And now you can walk into a bank and feel a little bit more confident with the terms that we use and we're going to ask you about and we're going to communicate with you about.
So I learned a lot today and through my time working at the bank and all of these terminologies. We hope that you have learned something from that.
So Jill, today we have debunked about 10 basic banking terms that everybody needs to know. And we hope that you will follow us on social media to learn more about these terms because we're always sharing stuff about the bank. You can subscribe to our weekly newsletter called In the Know. You can do that through our website. Just go to myfsb.com. And also you can learn even more about banking and finances through this podcast. Isn't that rich?
That's right. And these are not all encompassing. There'll be lots more terminology that we'll be bringing to you through our podcast. So be sure to subscribe if you are not anywhere you turn in, whether it's on Spotify or Apple or on YouTube. Subscribe, follow along.
And we hope that you enjoyed this episode. We will see you next week.
Yeah, thanks for listening. See you next week.